Hello, good afternoon, good morning to those of you that are in different time zones. My name is Michael Corselli. I'm the founder and chairman of FLYA. I want to welcome everyone to today's webcast, which will be hosted by EMQQ, the Emerging Markets, Internet, and E-commerce ETF. EMQQ is the #1 performing ETF in its category since inception. Today, we have the pleasure of inviting back Kevin Carter, who is the founder and CIO. Kevin has an amazing pedigree. He's a seasoned investment professional and entrepreneur in both the indexing and active worlds, with over 20 years of experience focusing on China and emerging markets. He's been a featured speaker for Columbia Business School, Bloomberg, Guggenheim Partners, Morningstar, and CFA societies around the world. Kevin was previously the founder and CEO of AlphaShares, an investment firm offering China-focused ETFs in partnership with Invesco. The founder and CEO of Active Index Advisors, which was acquired by Natixis in 2005, and the founder and CEO of E-Investing, which was acquired by E-Trade. And I believe they allowed you to buy fractional shares of equities. Kevin received a degree in economics from the University of Arizona and began his career in 1992 with Robertson, Stevens and Company. With that, Kev, thank you for coming back and joining us today. I'm going to turn this over to you for your presentation.
Great, Michael. Thank you for the intro, and thank you all for taking the time to tune in. So I'm going to do 3 things in my talk today. I'm going to first tell you about myself, how I got involved in emerging markets with an emphasis on China, also how I think about investing in general. And then I'll summarize for you what I think are the most important things about emerging markets for investors to know. And then I will hope to convince you that our approach is, in fact, a superior approach for long-term investors trying to capture the growth that is happening in emerging markets. So about me, I'm located 15 miles east of San Francisco in a town called Lafayette. I've lived here my whole life, except for a few years off in college. And I joined the investment business in 1992 at a company called Robertson, Stevens and Company, which some of you may remember was the leading technology-focused investment bank on the West Coast. We used to call it the Goldman Sachs of San Francisco, but now younger people seem to think that means the devil. So we don't say that anymore. But I started there in January of '92, and I had one interview. It lasted about 20 minutes. The first 19 minutes was a talk about college basketball. And then I got a 1-minute overview of the investment business. And then I was told I could start on Monday. And I immediately responded, well, how could I possibly start Monday? I don't know anything about investing. And the guy said, well, go buy this book. And he took out a piece of paper and he wrote down A Random Walk Down Wall Street. I went by the bookstore on the way home and picked up a copy and read it over the weekend. And some of you probably have this book and have read it, but many of you certainly know the name. It was first written in 1972. And in that first edition, the author, Bert Malkiel, suggested that somebody should create an index fund because there were no index funds back then. And a couple of years later, his friend John Bogle, in fact, did create an index fund and started Vanguard. So this book and its author have long been associated with indexing and efficient markets. Bert Malkiel, the author, is a Princeton economist and longtime Vanguard board member, and also the chairman of the committee that created the first ETF, the Spider. So that's how I started my career reading about indexing. But I very quickly gravitated towards Omaha. And I try to think about all business and investment decisions through my perception of an Omaha Charlie Munger lens. But for the last 20 years, I've actually been business partners with this guy, Bert Malkiel. So I've had one foot in the active world, one foot in the indexing world. As Michael mentioned, one of the businesses we started is called Active Index Advisors, which is now owned by Natixis Asset Management. And it was a pioneer in what's now called direct indexing, building customized, individualized S&P 500 based portfolios that would hopefully beat the market on an after-tax basis simply by using systematic tax loss harvesting. And so we built that company, and we were acquired by Natixis in December of 2004. But a couple months before that, Google went public. And when Google went public, they invited my partner, Bert, to Mountain View to give a talk to their employees about investing. And I wasn't involved with that investor planning day, but I heard about it and had dinner with Bert the night before. And a few months later, my phone rang, and it was a guy from Google who had Googled me. And he said, hey, I heard about this active indexing and I want to invest with you. And I said, great, who's your advisor? And he said, I don't have an advisor. And I said, well, we only work with advisors at Morgan Stanley and Credit Suisse and Deutsche Bank. And he said, well, I don't have an advisor at any of those places and I don't want one. And he convinced me to basically become his investment advisor. So I became his go-to for his investment portfolio. And then he introduced me to a number of his other very early Google employee engineer friends of his. And so this is in early 2005. And while I'm going back and forth to Mountain View, Burton has become obsessed with China, and he's going back and forth to China. Colleagues who were Chinese nationals that had been teaching economics at Princeton and had returned to teach economics in Beijing. And all of his back and forth led to the publishing of a white paper in the Journal of Investment Consulting, making the case for investing in China. That later became expanded into a book. And the Google people found out about this white paper, and they called me and said, hey, can Burton come talk about China and investing in China? And it was 16 years ago, this past April, that Burton was in San Francisco, and we drove down to Mountain View one morning. He gave a talk about investing in China. And then all of these people at Google looked at me and said, we want to invest in China. And at that point, I had never been to China before, and I didn't really know anything about China other than what I read in Burton's paper. But somehow, from the moment that talk ended until today, my entire life has become focused on figuring out what on earth does that even mean to invest in China, and how should an investor go about doing it. So with that lengthy lead in, let me tell you what I've learned over those 16 years. So first of all, when we talk about emerging markets, just to frame up this asset class, we're talking about 60% of this is an Asia story. When we talk about the populations, the GDP, the market cap, this is about 60% a story of Asia, with China being the largest part of that. It's about 20% in the emerging Americas, with Brazil and Mexico being the largest part there. And then it's about 10% Africa and 10% Eastern Europe, led by Russia. So that's what it looks like on the map. Fundamentally, we're talking about the world. This is 85% of the world's people. It's even more of the future as measured by young people, those under the age of 30, for which they're almost 90% of the world. Their economies have been growing on average about twice as fast as the economies of the developed world. They're now bigger than the developed world collectively. But if you look on the right side of the slide, you'll see the emerging market share of several different categories. The top one with a red arrow next to it is showing you again that this is where most of the world's people live. The bottom two red arrows are pointing out that in the categories of consumption, these emerging market people are way behind. And so it's the delta between the population size and the amount that they consume, and the closing of that delta, that's lesson number one. And that is ultimately the most important part of the story. The thing that is emerging are the people, billions of people moving on up, and they want stuff. They want the stuff we have. They want more and better food, more and better clothing. They want appliances. They want entertainment. They want to go on vacation. They want a car, and they want their kids to go to Harvard. And that's the story. It's very well documented. I didn't have to figure this out. You can see at the bottom of this slide that McKinsey and Company actually calls it the biggest growth opportunity in the history of capitalism. So that's a hyperbolic statement, but even if they're wrong and it's the second or third biggest growth opportunity in the history of capitalism, it's a big deal. And it's what everybody focused on emerging markets should be looking to capture that growth. So we'll come back to this because it's the foundation of EMQQ. Now, excuse me. The second thing that I tell investors they need to know is that there's some real problems with the traditional indexes that track emerging markets and with the ETFs that track those indexes. And this is a problem that I learned, at least the biggest problem I learned about in the first 5 minutes after we got back to San Francisco from Mountain View that day 16 years ago. So when we got back from Google and got up to the office, I walked straight over to our investment team and I said, give me a list of all the companies in the iShares China ETF with the ticker FXI, because I assumed that's how we would give these Google people their exposure to China, by buying the first and largest and most established China ETF. And I wanted to get a list of the companies because I like to look and see with my Omaha brain what exactly are the companies in the index. And so I asked for the list. And before they gave me the list, Burton pulled me aside and he said, look, when you get the list of all the companies in the China ETF, you're going to see that the vast majority of them are Chinese government-owned banks and oil companies, state-owned enterprises. And I said, yeah, I've heard about that. And Burton said, let me tell you how these businesses work. And he gave me the following example. He said, you've got a Chinese manufacturing plant with 15,000 employees that's incredibly inefficient. It's been losing money for 10 years, and it's about to go bankrupt. And it goes across town to the Chinese state-owned bank and says, we need more money. Now, a normal banker would say, no, you didn't pay us back the last money. But the state-owned banker doesn't say that. The state-owned banker says, well, if you run out of money, then these 15,000 people are going to be out in the streets protesting. And we can't have that sort of civil unrest. And so the bank makes another loan. Now, that made me literally nauseous inside, because with my simple Omaha brain, earnings equals value, and the growth of earnings equals the growth of value. And if the people that run these companies don't care about that, why would you invest in them at all? And in the case of the China ETF, it was about 80% state-owned enterprises. In the broader indexes and the ETFs that track them from iShares or Vanguard, it's about a third of the index. And these companies aren't, in addition to being inefficient, poor corporate governance is putting it quite mildly, because the corruption is rampant. And you don't have to look very far. Pretty much every week, you'll see a story about some sort of corruption and financial malfeasance going on in these types of companies. And the best example is Petrobras, the Brazilian oil giant that was being systematically looted of billions of dollars by people, including the last two presidents of the country, who both went to jail for basically stealing your money or your client's money if you're using these traditional broad index approaches. And while the SOEs are a third of the index, there's two other groups of companies that are kind of like SOEs. At least they have a lot of the same problems. Those are the oligarchs that took over the Soviet SOEs and the chaebol in Korea. And again, the problems are very similar. In Korea, you have this somewhat ongoing scandal involving the chaebol. These are a couple of protesters wearing masks. The mask of the woman, that is the face of the former president of the country, who went to jail after being impeached for taking bribes from the man in the other mask. That's the former chairman of Samsung, who went to jail for bribing the former president of the country. Now, he did get out of jail just in time for the Olympics, but he went back to jail again for other financial crimes in just the last 6 or 8 months. So this is a big problem, and it's why you can't expect to make any money or any real money using these traditional broad approaches. And you have to do what we call emerging markets 3.0 and get a little bit more targeted in your approach. So now, I didn't invent this concept, I lived it. And then I stumbled on the white paper that I've mentioned at the bottom. And when I read it, I knew exactly what the author was talking about, because it was basically what I had lived in my first 8 years on the China front. So in those first 8 years, we launched a number of China ETFs with Guggenheim that now have the Invesco name on them. But when I wasn't with the Guggenheim people, I spent my time in New York City and Boston with a couple of dozen foundations and endowments. And I watched how they were approaching China and emerging markets. And it started with a small allocation, a toe in the water, if you will. You can see Harvard's allocation plotted along this. But then investors get a little bit more comfortable. They increase that allocation, call that 2.0. But then as the allocations get larger and they see they're not really getting the returns they hoped for, they see people going to jail, and they decide they have to get a little bit more targeted in their approach. And in one of the best examples of this, Yale University had a young Chinese national who was a graduate and working for David Swensen in the endowment. And he wanted to set up his own shop, and David Swensen funded him with $50 million. And the firm Hill House was started, which has turned into an enormous success for everybody involved. But most investors didn't have $50 million and couldn't set up something like Hill House, as David Swensen helped do. And so what I told the most investors is, look, just buy the emerging market consumer sector, leave out the legacy economy and the corruption and the banks and the oil companies, and just go where the growth is. And that is in the consumer sector. And so when people would ask me, what's the best emerging markets ETF? I told them that's easy. You buy Econ, ECON, the emerging market consumer ETF, which owns the 30 largest emerging market consumer stocks, according to Dow Jones. Now, I had nothing to do with that ETF. I didn't know anybody that worked there, but I knew that it existed. And if you believed this slide, if you believed McKinsey and you believed me, that was what you wanted to do. And that was the best emerging markets ETF. And it was about 7.5 years ago that I woke up one day and I thought, what on earth have I done with my career? I was this young, cocky stock picker, Charlie Munger wannabe, but somehow I got mixed up with this Vanguard guy at Princeton, and now I'm building Chinese index funds, and I've obviously completely lost my direction professionally, and I need to get out of here. And so I told the Guggenheim people I would continue to support them, but that I was going to set up my own partnership and do my Warren Buffett meets emerging markets routine. And I did that. And once I had my partnership set up and an account opened and funded with my own money, I invested in 5 stocks, all of which were plays on this incredible emerging market consumer story. Then after I had my own money invested, I thought, well, I should see if any of my friends want to invest with me. So I scheduled some appointments, and the morning of those appointments, I sat down and I made a few slides to show the people I was going to be meeting with. And one of the slides was a list of the 5 companies that the fund was invested in. The first 3 companies were all in the emerging market consumer ETF. Those 3 companies trading in Hong Kong were Want, which you can think of as the Nabisco of China, food, snack foods branded. The second and third companies, also in the emerging market consumer ETF, Li Ning and Peak Sports. These are best thought of as the Reebok and Converse of China, sportswear, basketball shoes, etc. So those were the first 3 stocks, all of them traditional consumer. Then I had 2 other stocks that were very clearly part of this emerging market consumer story, but they were not in the emerging market consumer ETF because they'd been placed in a different box. They were called technology companies. Those 2 companies trading in the United States, first on the New York Stock Exchange was WuBa. You can think of this as the Craigslist of China. It's since gone private. The fifth and final company trades on the NASDAQ. It's called Mercado Libre, MELI, which is the Amazon.com, if you will, of Brazil and Mexico and every other country between those two. So those were the 5 stocks. And after I made the slide, I looked at it and I thought, well, all of these are plays on the consumer. The 3 that are called consumer are great. They're growing at 15%, maybe 20%. I think they have moats in form of brand equity. But then I looked at the 2 other companies that weren't called consumer companies. They were growing at literally 100% and had incredible margins. WuBa had a 94% gross margin, which is where I look for moats. And I've still never seen a company that was that profitable at the gross level. So I looked at the stocks and I thought these ones are growing 7 times as fast. And while the PEs are higher, the PE divided by the growth rate, the PEG ratio, which is all I really care about, was in fact lower and quite attractive. And that was it. I printed my slides. I went to my meetings. I got some checks. I was on my way home and I was at a stoplight and my telephone rang and I answered it. And it was a friend of mine with a 3-year-old daughter. And my friend said, "What's the best emerging markets ETF for my daughter's college fund?" I started to tell her to buy econ because that's what I told everybody else that asked me that question. But then a light bulb appeared above my head and I thought, wait a minute, the best emerging markets ETF doesn't exist. And I went back to my office and I began to organize EMQQ that afternoon, and it launched 100 days later on the New York Stock Exchange on November 12th, 2014. So now let me tell you how to think about EMQQ. It wasn't as clear to me then as it is now. I could see that these were clearly consumer companies, no matter where they were placed in the database. I could see their incredible growth, and I could see that the valuations were in fact quite reasonable when the growth was factored in. But what I didn't appreciate was what was causing this. And really what's causing it is a combination of 3 different mega trends happening at the same time. And in many ways, there are things that we've sort of taken for granted because we were the first people involved with these so-called mega trends. But I think, as I will hope to convince you, that this is creating what is, in my opinion or belief, the fastest growing sector in the world. And so let me tell you what those 3 mega trends are. The first one is this. We've already covered it. Billions of people moving on up, and they want the stuff that we've had. Now, when I got that call 7.5 years ago, I answered it on my smartphone, my iPhone, which was sitting on the car seat next to me. So I had a smartphone when I got that call from my friend, but I had only had it for a couple of years. It was pretty new to me. And I could already see how it was changing the consumption in my family. Back then, my family was going to this store 4 times a week, 5 times a week sometimes, which was easy to do. It's only 3 miles from our house. And we have a car and the roads are paved and there's free parking. But all of a sudden, I was noticing this guy coming to my house once a week and then twice a week. Now, before the coronavirus came, my family didn't go to the store anymore, except for maybe once a month. And meanwhile, this guy and others like him were at my house so often that I could tell what color the truck was without even seeing it. So if you think about how this device has changed our consumption, and you map it over to these people in the developing world, then the story gets really big, because I had a computer for 20 years before I had a smartphone, but the reality is most of the world has never had a computer before. So the second megatrend in the EMQQ story is the computer. And but if you're thinking of the one on your desk, it's not that. So all of these billions of consumers are getting their first ever computer. It's in their pocket, and it, in most cases, doesn't have an Apple logo. These are Android-based machines made in China. that are selling for $50 or $60 brand new in some cases. So the affordable smartphone is bringing the computer to the world for the first time. They're getting better and more affordable every year. And they're bringing with it the third part of the story, the third mega trend, which is called the internet. Now, I got internet access in 1995 in the Marina District of San Francisco over a telephone line with a modem for the first time. Then it went into the cable. Now it just shows up in my pocket. Well, the reality is that most of the world has never been wired before. So all of these people are getting online for the first time, and it's still pretty early. You can see here on this slide, smartphone penetration by country, the yellow or gold bars being the emerging markets. And you can see that in some of these places like India, the penetration is only about 30%. So you've got almost 1 billion people in India alone, but a couple of billion people still in the developing world that don't have a computer or the internet, but that's changing very fast. So you combine these three mega trends and the result is this: massive growth. This is showing you the revenue for the emerging markets internet sector over the last 11 years. And you can see in red that the average growth rate over that period is 37% a year. Now, I'm not positive, but I have given this presentation to hundreds of professional investor groups. I've offered $100,000 cash reward to anybody that can show me a sector that ever grew for 37% a year on average for 10 years. I've asked everybody I know who's smarter and older and more experienced than me if they can think of a sector that's ever grown this fast. And so far, my inbox is empty. So I might be wrong, but I'm 99% sure this is the fastest growing sector in the world today, and in fact, ever, in my opinion. So I could be wrong, but that's the result: massive, perhaps unprecedented growth. And what comes with that? Value creation. You can see in blue how investors have done in this space over the last 12 years. And in yellow, bouncing along the bottom, you'll see how the broad indexes have done over that 12-year period. And you can see there's a 69% return for the broad index, but all of that came in the last 18 months. So before that, a lost decade in emerging markets. And if we actually made this chart 2 years longer, the yellow line just got back to break even. So now let me also make a public service announcement here. I think that emerging markets are the largest value trap in the world. And I see it over and over again. Some chief investment officer will go on TV or write a report and say, we are very bullish on emerging markets and investors should invest in the MSCI Emerging Markets Index. And they say, here's why. Look how cheap they are. The PE is 12 or 13. So it's half the price of the S&P 500's PE. The growth rate in these economies is twice as fast. So I'm getting twice the amount of economic growth. I'm paying half the PE multiple. How can that not be a bargain? Well, if you knew what the Agricultural Bank of China was, you probably wouldn't want to own it at 3 times earnings. So I think that investors broadly have been disappointed in emerging markets and their lack of returns. And I think they're going to continue to be disappointed if their approach is the broad traditional way. Now, the poster child for this story is Alibaba. It's not the largest now. Tencent's actually got a bigger market cap, but Alibaba still the best known of these companies. And it trades here on the New York Stock Exchange. And let me point something out. This is the second biggest problem with the indexes. So when Alibaba came public, it shined a light on a problem that I also discovered on the first day. So I told you how Burton gave his talk about China in Mountain View, and then we went back to the office and I asked for a list of all the companies in the China ETF. Burton pulled me aside and said, watch out for these SOEs. And then I got the list and I went down the list and I got to the bottom and I said, where's Baidu? Because Baidu, the Google of China, was not included in the iShares China ETF. And we called the iShares people and said, where's Baidu? And they said, we don't own Baidu. And I said, I know, I can see that. Why don't you own Baidu? And they said, well, we don't consider it a Chinese company. And I said, what do you mean? It's the only Chinese company I knew before you gave me this list. It's the Google of China, and being the Google of anything seems like a good idea. And they said, well, we don't own it because it trades in the United States. And I said, that's the stupidest thing I've ever heard. So for most of the time that this blue line was going up, the yellow line didn't include the stocks in the blue line to add insult to injury. So you didn't own Baidu and you didn't own Alibaba until 3 years after the IPO. And it was, fortunately, the Alibaba IPO got so much attention that even the Consumer Reports and USA Today uncovered this fact and wrote about it, that they weren't even going to include Alibaba in your Vanguard fund. So you're going to get the state-owned oil companies and corrupt banks in Brazil and oil companies in Brazil, but you're not going to get these internet companies. And a lot of these companies, about half of our companies, still are not included in the broad indexes. So, and this is a real shame. And the reason is, the reason these companies are trading here is because they're getting founded by locals, but they're getting funded by US institutions like Harvard or Stanford, or in these two examples, corporate investors. Jerry Yang, of course, leading $1 billion investment into Alibaba, which turned out to be by far the most valuable thing Yahoo had at the end. And in my favorite story from the last couple of years, this Brazilian fintech company, Stone, came public, and my heroes in Omaha bought 5% of the company on the IPO. So, the point is that in a part of the world where corporate governance is your biggest problem, these companies, on a relative basis, you'd have to say have very good corporate governance, and on a relative basis to things like Petrobras, you'd have to say they have exceptional corporate governance. And so in a part of the world where that's your biggest risk, you can sleep a little better at night. But let me point out, this Brazilian fintech company that Berkshire's invested in, that's not in your Vanguard or iShares funds. The Brazilian oil giant Petrobras is in your funds twice, but not the Berkshire Bath fintech Stone. Now, Tencent is the largest company by market cap currently. Not as well known as Alibaba, but bigger. To make it simple, we've always told people it's the Facebook of China. And it's true, the WeChat platform is the social network. It's how I talk to my Chinese friends and colleagues. So it's fair to call Facebook or Tencent the Facebook of China, but you can't call Facebook the Tencent of anything. And this is an important point. In the case of a lot of these companies, and in the case of Alibaba and Tencent in particular, these companies don't have a US equivalent. And the reason is, in the developing world, the consumption infrastructure is by definition underdeveloped. And when I say consumption infrastructure, I'm talking about bank accounts with a debit card in everybody's pocket. I'm talking about TVs on the wall with 1,000 channels. And I'm talking about Target stores. Because those things don't exist in the developing world the way they do here, it's allowing Alibaba and Tencent to go into every consumer vertical and compete. What do I mean? Healthcare. Alibaba's healthcare business is now a separate publicly traded company. JD.com IPO'd their healthcare business in December. Tencent will likely IPO its telemedicine business, WeDoctor. So these companies are in healthcare. They're in entertainment. The Spotify of China trades on the New York Stock Exchange. Tencent Music and Entertainment, TME, separate publicly traded company. Groceries, there's amazing stuff going on in the developing world in food and groceries. And this is Alibaba's grocery store, Hema, which is still the most amazing thing I've ever seen in China. It is quite literally a combination of the Jetsons and Whole Foods. So these are not technology companies. These are consumer companies thriving in a smartphone-centric world and competing in every consumer vertical, the biggest of those being financial services. So this is the biggest sub-story in EMQQ. And the way it plays out all over the world is it starts with payments. It starts with getting the money onto the phone. Here's a picture I took in China a couple of years ago. And in any Chinese city, in the mornings, the people come in from the countryside with their eggs or their produce, and they set up in the alleys and sidewalks to sell what they've got. And if you look in the red circle in the foreground, you'll see two QR codes, one wrapped in green, one wrapped in blue. The green one is Tencent's payments platform. The blue one, Alibaba's payments platform. Every place in China that you want to use, that you want to spend money, you're going to find those two QR codes. And if you sat on the corner and watched this business all day long, you probably wouldn't see one piece of Chinese cash change hands. And this is everywhere. And the same day I took this photo, I tried to buy a bottle of water in the train station and was denied with a Chinese banknote. But meanwhile, up on the streets, I could buy anything I wanted with a QR code. So this is a big deal. And you can see here that Alibaba and Tencent own this in China. And because once you get the money on the phone, you can get into the investment products business, which Alibaba has done in partnership with Vanguard for mainland China. You can get into the insurance business, and you can get into banking and lending. And that's where the problem lied with Ant Group. We'll talk about that towards the end. But this fintech story in emerging markets is really, really powerful. And it's sort of a paradox. You would think that someone like me, a fintech entrepreneur in San Francisco, you'd think that I would be somehow on the cutting edge of this. It's not me. It's the developing world where, for example, more than half of the world's mobile phone-based money users are in Africa. So it's this leapfrogging over traditional banking and traditional everything to digital consumption, and fintech, the biggest part of that. So other geographies, Southeast Asia is on fire right now. This is C Limited, one of our holdings based in Singapore. You won't find this in your broad indexes. This happens to be one of, if not the best performing large company in the world. It's been neck and neck with Tesla. I think it's probably pulled away recently. So in this company, there's no US equivalent. This is a company that combines gaming, it combines e-commerce, and really a big deal, fintech and payments as well. This is one of the companies that inspired EMQQ, headquartered in Argentina. Mercado Libre is both the e-commerce and fintech leader in all of Central and South America, largest markets being Brazil first, Mexico second. This is not a company you'll find in the broad indexes. It's also been a very strong performer and doubled in each of the last couple of years. Eastern Europe, this is the Google of Russia. It's also become the Uber of Russia. YNDX taxi beat Uber in Russia. Uber did take a minority stake in YNDX when they left Russia. You won't find this company in your broad ETFs. You will find the oligarchs. India's got a lot going on. We'll talk about some of the IPOs coming. Only a few public companies so far. This is one example, Make My Trip, this travel app for India. And even Africa now has its first homegrown New York Stock Exchange listed e-commerce company. This is the Nigerian leader Jumia, which is also in the fintech space as well. And it operates not just in Nigeria, which is the largest market in Africa, but in 8 or 9 other countries as well. And so other recent IPOs and some stuff coming down the pipe. We had the Amazon.com of Coupang. I'm sorry, the Amazon.com of Korea IPO'd earlier this year on the New York Stock Exchange, now part of EMQQ. This company is fascinating in that it is the leader in environmental packaging, and a lot of their deliveries are without packaging at all. This is a Russian, second biggest e-commerce company in Russia. Ozon came public on the NASDAQ in the 4th quarter. The Amazon.com of Poland is now public and the largest company in Poland, trading in Warsaw, Allegro. Now this one should price tonight. This is the Uber of China, Didi which counts both Alibaba and Tencent as early investors, and it also counts Apple as a shareholder. And it also has Uber as a major shareholder. Uber went to compete in China, but got crushed by Didi and also left China, but not before taking a minority stake in Uber. So this, or rather in Didi. So this company will price tonight, it looks like. India's pipeline is very big. This is Flipkart, the e-commerce leader that Walmart controls. It should IPO in either the fourth quarter or the first quarter of next year. Also in India, PAYTM, the fintech leader, looks like it's preparing for an IPO. This company is about 40% owned by Alibaba, so you're already getting exposure that way. And I like to feature it because, once again, my heroes in Omaha are an investor in this emerging markets fintech company. Southeast Asia, a lot going on. We've got Grab from Singapore going to merge with the Altimeter SPAC. And then these two companies, the Indonesian e-commerce leader and the Indonesian ride-hailing leader, merging to form GoTo, a combination of Gojek and Tokopedia. This will give it about a $40 billion market cap. It will probably IPO later this year or early next year. And then in Brazil, you have the world's largest online bank, NUBANK, which should IPO this year, but they just raised $500 million from my heroes in Omaha, the third fintech, emerging market fintech company that they've invested in. They just invested $500 million 2 weeks ago in NUBANK, so that might push out the need for the IPO a little bit, but this one will come eventually. So this is, in summary, a story of growth explained by perhaps these three mega trends happening at the same time, and a lack of traditional consumption infrastructure and a leapfrogging, if you will, explaining the growth rate. Side benefits to the growth, better corporate governance in a part of the world where that's your biggest problem. And you also end up with a lot of exposure to the pre-IPO companies because of Alibaba and Tencent's investment portfolio and lots of frontier markets. In terms of what's going on in the world today and the buy-seller hold decision, obviously we've just gone through a pretty significant event, and most of the world's not done with it, or even close to done with it. The emerging markets have suffered greatly, the dense populations and the poor sanitation and healthcare really bearing heavy on these people. India and Brazil in particular have struggled. And fundamentally, there's going to be a lot of these emerging market consumers are going to go backwards in this. They'll come back eventually, but this has certainly been a setback for millions. Now, China's had a lot of advantages in this. They never eradicated the virus, but they were able to control it better than anybody. And they had one important and simple tool for that called smartphone-based contact tracing. So they were able to limit the outbreaks to a few hundred people at a time. And that allowed them to actually have growth last year. And well, even this year we'll have significant growth of probably 8% or more. And they haven't had to throw trillions of dollars at this. So China has advanced on a relative basis to the rest of the world in the last 18 months. And finally, and somewhat uncomfortably for me, since the reality of this came to be, but the fact is that this pandemic has done really nothing but accelerate all of the trends that are driving the EMQQ story. So with the exception of travel. So we were pretty well positioned and ended up having a good year last year, and started this year very strong. And then we hit a big air pocket. No real clear correlation, at least on the calendar, between our recent 30% decline and the bad news in the world. But let's talk about what are the worries out there. And they seem to be largely around China. And it all started in November when the Ant Group IPO was pulled. It was going to be the largest IPO ever. This is the fintech arm of Alibaba. And I was actually happy that they pulled the deal, because there was a frenzy to buy the stock in Shanghai and Hong Kong, and you had $3 trillion of demand. And I was very concerned about how the stock was going to trade, largely because half of it was going to trade in Shanghai and half of it in Hong Kong. And the stocks, there's about 150 that trade duly listed on those two markets, but they don't trade at the same price because you can't short in Shanghai. And so there's no way to arbitrage the price difference. And the Chinese mainland investor is a frenzied Robin Hood investor. We talk about how the Robin Hooders have become 15% of volume here in the US. Well, in China, they're 80% every day. So very much a speculative market. And so I was just concerned about the heat on the deal. And I wasn't expecting them to pull the deal, but they did. And when they did, I could see both sides of it. I saw the regulator's point about this, and I also understood the Jack Ma and the Ant Group people, but I saw it as sort of a 50-50 balance between the establishment, the regulators, and the disruptive fintech company. But now I actually completely see the side of the government, and I think they did the right thing, and I think they had to. And so, the problem with what Ant Group had going on, as I mentioned earlier, the payments part of the platform, not a problem. The investment platform, not a problem. The insurance platforms, not a problem. It was the lending platform that was a problem. And so the lending business, the two different credit products that Ant Group had were becoming enormous. They were generating more than half of the profits of the company. The company was massive. It had 10 billion of revenue, growing at 40%, and it had a 30% net margin. And again, most of that was coming from the lending business. But the way they were operating is they were originating loans, lots of them. 500 million people originated some credit on the two platforms in the year leading up to the registration. But Alibaba or Ant Group wasn't holding on to the loans. They were scraping off the cream, pushing the risk out onto the banks. And that's how you get a 30% net margin. But the regulators, I think, rightfully thought that this needed to be looked at a lot more like a bank. And so they pulled the deal. And again, I now see their point 100% on this. And in fact, in the last couple months, I've actually started to see this as really, this part of the story as more of a positive than anything. And because of how efficiently they were able to pull the brakes on this sector and put in place the regulations they were already working on to help minimize and control the growing risks to the fintech story, and then push the restart button. And that from November 3rd, when they pulled the deal, until April, when they cleaned it up, for a major economy, you think about how much lobbying and back and forth would go on if we attempted to do something like that. And you look at the speed and decisiveness with which they put in new regulations, I think it actually speaks to me of the strength and benefits of their system. Now, there's no doubt that a significant amount of value has been lost. About the entire Chinese fintech sector lost 35% of its value. I think that's a fair way to think about this. I know Fidelity's marked down their Ant Group stake by 50%, but if you're going to take a write down, you may as well overshoot. And so that's real. And the fact is, these companies aren't going to grow as fast. They're not going to be as profitable. I still think Ant Group's going to be $1 trillion company one day. It's just going to take longer. So that happened. And I don't actually take it as a negative. I think the market still does. People think Jack Ma was missing, as if a van swept by and they shoved him in and took him away for interrogation. That didn't happen. And but nonetheless, all of the people that are scared of China and think all these negative things about it, they let their imaginations run wild, and they think that Xi Jinping personally canceled the deal because he didn't like Jack Ma. And I think these things are silly. In terms of the antitrust issues, these didn't bother me either. And, the goal of any business is to win. And if you're winning so much that you are powerful enough to be looked at as monopoly, then you're doing something right. And so I wasn't bothered by it. And also, it wasn't really a secret. I mean, some of the things Alibaba was doing were out in plain sight, like the choose one of two policy. So they cleaned that up as well. And now there was a monetary penalty of $3 billion, and they've gone through the rest of the industry and dinged people here and there. But I take all of these as as positives, frankly, especially when I think about how negative everyone else takes it. And the reality is that it leads to what I think are very attractive valuations. Now, as I mentioned, we did have a big decline. It didn't seem to get triggered by the Ant Group poll. That was in November. But it did happen, and you can see that down below that it's happened before, and it's going to happen in the future over and over again over the decade ahead of us. We'll have 30% declines, I'm sure, and we have in the past, and you can see we just had one, but you can see at least heretofore the year after those declines have been very good for investors. So we'll see how the next 10 months play out, but historically this has been a good thing. And now let's just look at what I really care about, which is the PEG ratio. You look in the lower right, you can see the PE over the growth rate for this group is less than 1 currently. You compare that with the FANG stocks that have a PE that's about the same, but a growth rate that's meaningfully less. And we're looking at a group that's the FANG stocks maybe twice as expensive on a PEG ratio basis. And then the S&P 500 may have a PEG of 3 at this point. And so, or at least 3 times the PEG of this group. So with those relative multiples and with the risk-free rate at not perhaps 0, but pretty close to 0, I think valuations are quite attractive for mid to long-term investors. So that is the end of my prepared remarks, Michael, and happy to stick around and do as much Q&A as you have time for.
Absolutely. Oh, sorry about that. All right. So what impact has currency, specifically dollar versus EM currencies, had on total return, and how will currencies impact return going forward? Denal, thank you for your question.
So first of all, we don't hedge for the currency. Many of these stocks, by the way, trade in US dollars, but we don't do anything to hedge. And the reality is that the largest exposure is China and the RMB. And I don't have any currency opinions of my own. It's not something I have any expertise in, but as with a lot of things, I usually defer to my Princeton economist partner, and I know he's from the beginning said that he doesn't have opinions about any currency except for the RMB, which he has felt is the most undervalued currency in the world. So we don't do anything for currencies. Interest rates, the dollar, these things certainly have impacts on the performance of emerging markets historically, but we don't do anything to try to stay away from that.
Okay. Next question is from Angela Cole. Angela Cole had a very interesting question here. Just trying to find it. You got a ton of questions. Hang on 1 second. All right, Michael, very interesting presentation today. How will the aging Chinese population and the easing of the child's policy rule impact production and consumption in China in the near term and for the long term?
So, well, it'll impact some parts of consumption negatively and some positively. That China does have an aging population, as do a lot of places in the world. And I think the demographics for China are actually better than they are for the US and for Western Europe. And Japan, of course, is sort of the poster child for this. But China's going to have to deal with it. And they know that, and they've, as alluded to in the question, they've been relaxing the one-child policy. They went to a two-child policy, and now they're going to have as many children as you like policy. That won't be enough to offset the aging, but it will help. So I don't know how they'll deal with it, but they will continue to do what they can. And again, this is a problem that a lot of places face. And China still has even with the one-child policy, China's had a higher birth rate than the Catholic countries like Italy. So lots of people dealing with this. China not unique to it.
All right. How mature is the EMQQ growth story now? And do you see it performing similarly over the next 5 years?
Well, it's collectively for all emerging markets, I'd say it's in the third-ish inning, but that's heavily swayed by the fact that China is the biggest emerging market and it's the most advanced in the story. But even in China, you're seeing that the largest companies are still growing at 30%. That will decline. So I think the growth rate, that 37% a year growth rate is going to decline. This year may be above that, but it's going to go back down. It'll be under 30 in the not too distant future. So it's going to flatten-ish. But if you look at places like India and Africa and South America, these places have a long, long way to go. E-commerce penetration is very small in a lot of these places compared to China. And the growth rates will be faster. And India in particular has the biggest growth opportunity with its vast population. But in terms of the overall story, China is such a big piece of it that's going to carry the whole thing down, but still, with incredible, it will still be the fastest growing sector in the world with China included. But if you took out the China part of it and did this sort of ex-China, the growth rate is certainly going to be higher. So it varies by region. China is the biggest, but it's also going to be not the fastest growing. I hope that wasn't terrible.
This next guy must be a trader. Top 3 reasons why they should buy EMQQ now.
Well, I can't. I don't know if he's a trader, he or she is a trader or not, but I think he's. This is for anybody that has a 3 or 5 or 10-year outlook for investing. I think this is. I don't know of anything I would rather buy and own than this if you have a long term approach. And I think that, Michael, one of the things that I can't stress enough that I feel about investing is how important the miracle of compounding is. I mean, the miracle of compounding was around before, the concept and the math of it was around before me. And it's just so important for investors. And so I think anybody that has a long-term investment horizon should have this as part of that. And now I'm obviously in a biased position, but in my brain of brains or heart of hearts, I really truly do think that this is the best investment. I can't think of anything better to own than this if you have a long-term time horizon. And that's why the vast majority and almost all of my and my family's investments are in the space, in EMQQ specifically, or in some of the individual companies. Now, in terms of if the short term, if I was talking to a trader, again, I don't, I can speculate about the short term, and I would say that as I showed, when we've had these declines in the past, the 1 year after those have been good periods for investors. And then I would also just say that my gut right now is somewhat favorable. As I mentioned, we didn't have that much selling and redemptions in the fund. And, all we do is talk to advisors all day. And, we get a pretty good sense for the pulse of things. And I would say right now the pulse seems favorable. And I would also say, this is kind of corny and this is totally gut, but the way that we've traded the last several sessions, I find encouraging. I just, it's trading well. And so I have a good short-term feel, but ultimately that's just speculation. What I know is that over the long term, earnings have value, and the growth of earnings equals the growth of value. And right now, the valuations I think are very compelling, and I think a lot of that's because of the so-called China discount.
Got you. Okay. So for those of you that are on today, it was supposed to last till 2 o'clock. Kevin, will you continue to answer questions?
Sure.
Okay. So if you want to stay on, please, we invite you to stay on, keep asking the questions. We're going to keep plowing through them. For those of you that don't have the time, please feel free to drop off, and just know that we're thankful from EMQQ and from Flya for you attending today. All right. So with that, what's your view on the downside risk to EM tech company valuations in the context of increasing concerns about elevated valuations in developed tech markets like the US? And Noman, thank you for the question.
Well, I think the risk is low, but it's real. I mean, I think that we could have another 30% decline to go on top of the 30% decline we already had, and we've come back a little bit from that 30% decline. But these are short-term things. I mean, while we dropped 30% from February to May, our year-to-date number is flat. So for the last 6 months it's been exciting, both up and down, but not much has really happened. So I think that I don't look too closely at the U.S. Tech leaders, but I see right here that their valuations are comparable, but the growth rates are not the same. So, but let's say that everything gets taken down another 30%, and let's say then that the multiples freeze. Well, when you're growing at 3% a month, 10 months later, you're right back where you started. So I take great comfort in the growth that is happening, because if an additional 30% decline happened and you have a PEG ratio of 0.5, well, then I will be very, 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 very much pounding the table. I'm lightly pounding it right now. And but for long-term investors, I'm giving it a solid bang.
All right. Do you anticipate EMQQ getting more exposure to India or other geographies besides China in the coming rebalance?
Well, we just did a rebalance last Friday, or the Friday before that, rather. And we did get a little bit more India exposure. We picked up Reliance Industries, which controls GeoDigital, which we believe is now about half the value of the whole operation and likely to continue to become its biggest asset. So we have increased our India allocation by adding that company in the rebalance. And we're going to see a lot of IPOs as well, but there's also China IPOs like Didi, which will price today. So it's been pretty static at that 60%, 65% weight to China. And we'll have more IPOs, but they'll continue to the math will continue to play out, with the China having additional market cap. But let me just say this, and I know I saw at least one of the other questions about the heavy exposure to China. So one of the things that we as a firm are looking at doing is an additional product. We currently has the working title of EMQQ, F as in frontier. And the current version that we have on the table, if you will, that we're working on is essentially the same portfolio without the China exposure. So if you think of EMQQ as 65% China and 35% other, it's simply pulling out that 35% other and putting it out as a separate listing.
That's exciting. Somebody actually asked a question about that is, why does EMQQ only have one stock and not multiple stocks, ticker symbols with different funds?
Well, the reason is that as an entrepreneur, I was very set from the beginning that this was a very big story, and that it was a very big story, and that it had the chance to scale, and that I didn't need or want a quote unquote family of ETFs. And this is one of the things I've observed as an entrepreneur in this space, is there's a great temptation once you have a fund that works to say, well, let's make some more. And what I've seen many times is that a fund company will have one winner, call that the golden goose, and then they'll decide we need to launch a whole bunch of other ones. And the group I mentioned early on that when before I made EMQQ, I told people to buy Econ, the emerging market consumer ETF. And the organization that put that fund together, that fund was quite successful, and had over $1 billion in assets. And then they launched 10 or 12 other ETFs, none of which got even to break even, basically. So I didn't want to repeat that mistake, and I still don't. So I'm not positive that we'll put FMQQ together completely, but we are going through the exercise of seeing what it would look like and how it, what the growth rates and the valuations would be in the historical performance. And because it's not a different story and a different, it's basically just a subset of what we've already got. It's a little easier for me to swallow, and for us to put together, to operate the way we do with that as a separate listing. So, and I think in terms of the market, demand, we see a number of different investors that would be interested in this. You have people that don't want China exposure for any number of reasons. Maybe they own China tech ETF already, and so that they can sort of complete their EM exposure. You have a lot of advisors have used Alibaba and Tencent as their EM allocation, and maybe have gains on those positions, so they could, maybe they already have that China exposure that way. And then there's people that just, think Jack Ma's missing and that Xi Jinping is going to steal the internet or whatever. And those people, I've given up long ago trying to help people that have those types of outlooks. So I think there's a number of people that might find value in FMQQ. And if you want to lower the China exposure, you could blend EMQQ and FMQQ and create whatever China allocation feels right to you. So we will see, but I'd say if we did make another product, that's what it would look like.
Next question comes from a friend of mine, Larry Chiarello. How does crypto enter into the picture, if it does? Well,
very little around the edges. I mean, you had Mercado Libre put some on their balance sheet, sort of in a nod to Tesla and others. China's said no to crypto. There's been some mining there, however. And I know that the blockchain, both Tencent and Baidu have significant investments in blockchain technology, but I don't think crypto, at least presently, is in any way a meaningful exposure.
Got you. Okay. Let's see here. How should I think about adding EMQQ to an emerging market allocation?
Okay, well, this is an area where I obviously have vested interest in how people approach their emerging markets allocation. It's also an area where I've become completely radicalized and getting more so. And so let me tell you what I mean by that and how I think about this. So when we launched EMQQ, people would ask me basically the question that was just asked: how do I use this? And I'd say, well, you use it as a satellite. So use the Vanguard fund as your core, and use EMQQ as a satellite. And I didn't really feel that way, but I knew it sounded more palatable to people, and it cosmetically was easier for them to say, okay, that's how I should do it. And then not too far into EMQQ's life, I would tell people use the Vanguard fund as your core and use this as a satellite. And then I would say, you'll have less money in 5 years, but it'll probably be less volatile and it might be easier for you to do. Now I don't say that, right? I think that if people ask me how much I should have in emerging markets, if you're going to use the Vanguard fund or the iShares fund, I'd say none. So I think this should be your emerging markets allocation, but I've also, as I said, become quite radicalized, and I now completely reject modern portfolio theory and pie charts in general. And a lot of it has to do with just my, real world experience. So I have a relatively young team, and last fall, our 401k plan, the default funds were changed by the administrator, and they sent me a notice that they were getting rid of the Vanguard funds and they were going to add a bunch of Fidelity life cycle funds. And that made me want to barf. And I started to think about it. And, if I've got a 27-year-old employee who's got a 401k program and she's going to have that money, or he, in that fund for, in the 401k for 30 years plus, why does that person need any US mid-cap stocks or international bonds, right? And I just think about what I would have done differently in my life if I could go back 27 or 25 years and do my 401k. I would try to take the most advantage that I can of the miracle of compounding. And this group is going to compound its value faster than any other group I know or have ever known, frankly. So I'm radicalized. I think this should be part of your emerging markets allocation. I think it should, in my own world, it's all of my, not just my emerging markets allocation, but all of my allocation. But I guess the only other thing I would say is, if you have to use a core, and I know that your group isn't necessarily like a down the middle sort of financial advisor audience, but if you have to use a core ETF, then you use the Wisdom Tree XSOE, which is basically the broad emerging markets without the state-owned enterprises. And if you look at the long-term performance rankings of all emerging markets ETFs, you'll find that the second best performing one is XSOE. So just leaving out the state-owned enterprises was good enough to beat everything else so far. So and by the way, I'm if anyone at Wisdom Tree is on the phone, I think I might be the single best salesperson for that fund from Wisdom Tree.
So, Kevin, I have another question. This is more of a statement. Comes from Gerard. I've worked in the EM markets for over 30 years, and other than the commodity boom years, investors never made money. Your strategy to invest in technology of emerging markets beats all the emerging market competition and at a lower cost. I don't know if there's anything you want to add.
Well, I'd say thank you. And I know that is true now. So yes, I appreciate that. And again, I think it will continue to do very well for investors. And I guess the problem is, in emerging markets are probably the best example of this, but asset classes, themes, emerging markets, the sound of these things is great, right? Frontier markets, but people, ultimately the way you grow value is by growing earnings. And if the companies that are in that bucket for that asset class or that theme, if they're not actually growing their earnings, you're probably not going to make any money. And so that's, I think, the biggest problem is that everyone implicit in this idea of the word emerging is some kind of growth. And there is growth. It's just not translating into profits for the companies that are in the index that measures the asset class. And I think that's a problem. But I appreciate that comment. But you know, in the ETF world, a lot of people think it should all be free because Vanguard and John Bogle essentially are a nonprofit. And so when someone thinks of our expense ratio as being low cost, I appreciate that, because on a relative basis, I think it certainly is. And the last time I was queried about the 86 basis points we charged, we looked at our returns versus Tiger Global, and I know that Chase Coleman was the highest paid hedge fund manager in the world last year and made $1.5 billion personally. And we ran our returns versus Tiger Global's, and I did not make $1.5 billion, but we did outperform him by a meaningful amount. So thank you for that, whoever made that comment.
It's a nice value proposition. All right, next question is more relevant to the IPO you talked about earlier today, coming from Kevin Smith. How much do you expect to pick in Didi as a percentage of ETF?
Well, it'll be cap weighted, market cap weighted. We have a modified market cap weighting, so we limit the largest position to 8%. So when we rebalance, Alibaba and Tencent will be in that kind of 8% range. And the reason we have that 8% limit is because Alibaba and Tencent are so much larger than the third and fourth companies that we would be out of compliance with the diversification rule. So we have an 8% cap, and then it's market cap weighted beyond that. So a quick guess, if the market cap is 60 billion, it'll probably be a 3% weight, I would suspect, plus or minus maybe a point.
Got you. Can you share your thoughts? Since last time you talked a little bit about the Shanghai technology focused Star Exchange and A3H premium. Any updates in reference to any of that stuff?
Well, look, the A-share market is still the Wild West, and it kind of bothers me that this is another great example of people not really looking under the hood or thinking about the whole idea of you need companies to grow their profits. And when I first got involved, my first 8 years, when I was working with Guggenheim and launching ETFs, but I spent most of my time with institutions up in New York and Boston. And this is back when there was only 30 US investors that could buy A shares. There was the QFI quota program, which was pretty new. And there was about 30 institutions that had applied for a quota. And I met with most of those institutions, and they'd always say, well, we want to invest in China A shares. And I'd say, why? And most of them couldn't actually answer the question. They just knew that it felt more like China than Hong Kong. It was China, it was Shanghai. And it was sort of like, we were getting behind the rope, if you will, getting backstage in the A-share market. And so I'd ask people, but why do you want to invest in the A-shares? What about the A-shares is sort of this magical thing to people? And nobody could actually answer the question until I stumbled on one of the investors that invested with Yale in Hill House. And he said to me, we understand there are some consumer companies that can only be purchased in the A-share market. And I said, okay. And so I sort of deconstructed what happened. When Hill House was formed and David Swensen backed him, every other major, endowment and foundation up in the Northeast said, well, if you're good enough for David Swensen, you're good enough for me. And so most of the bluest chip investors got a shot at investing in a Hill House. And then this is sort of 2004 timeframe. And then they put I believe something like half of their portfolio was invested in two Chinese liquor makers, Kuaishou Mutai and Wuyang Yi Bin, which The Chinese stock market from 04 to 07 basically tripled, and Hill House quadrupled or was up fivefold or something amazing, and largely based on the performance of those two stocks, or almost entirely based on those two stocks. And it was true and still true that you cannot invest in the two Baiju companies, those two, outside of Shanghai. But that was 90% of the consumer sector. So there wasn't any other real consumer companies in the A-share market. And today, if you look at what's in the A-share market, it's state-owned enterprises, and it's the worst of the state-owned enterprises. The best state-owned enterprises manage to trade in New York or in Hong Kong, and the ones that are least worthy stay in Shanghai, and that's still a problem. And as mentioned, it's very much a casino mindset there, and yet I see it all the time. I mean, there's a few of these A-share ETFs here in the U.S., and the fund companies, obviously want people to invest in them, and so they promote them, and they promote the idea that somehow this is the real China stock market. But it's to me just a big casino, and it is the single market, I believe, and have for a long time, that's going to be the most prone to bubbles and crashes, and just the nature of the investor base. It is a boom and bust market, and I don't see any reason for that to change structurally. It's going to take a decade plus for that market to get a little bit more of an investment mindset as opposed to a casino mindset.
All right, you did cover the IPO failure in November, so I'm not going to ask you this particular question unless you want to elaborate on it at all.
No, I mean, again, I think that the Ant Group IPO failed, and again, I think that they had to stop it. It would have been a lot messier because they were going to have to change the business model, and if they let it come public and then they changed the business, the rules for the business, and investors lost money, ex post facto, that would have been a significantly bigger problem and harder to do. So I think it actually, as I said, it gives me more confidence in the Chinese government and in this story. And it also gives me, the ability I feel a lot more confident pounding the table, because all of these concerns, continue to lead to valuations that I think are extremely reasonable.